My name's Corey, and welcome to today's video where we're going to go over what to do when you inherit money. Whether we're talking about taxes, account types, or financial strategies, I have a hunch you'll find something useful in here for you. In today's video, we're going to cover many different asset types. This is going to include any property types, IRAs, 401ks, Roth IRAs, Roth 401ks, life insurance, annuities, debt, and stocks. Those are the main types that we're going to be talking about of assets that you could potentially inherit. On those subjects, we're going to again talk taxes, timelines, and rules to bring you up to speed. To make sure that we're all on the same page, a traditional IRA and a 401k are going to be considered retirement account types that use pre-tax dollars for funding. So when you take money out of those accounts, you should expect to pay taxes. Whether you are alive or you are an inheritee of that account, you should expect to owe taxes. Now, the opposite should happen with a Roth IRA or a Roth 401k. In the event that those dollars have been contributed with after-tax dollars and they meet certain requirements, the monies generally come out tax-free to the beneficiary. Now, talking about beneficiaries, if you are inheriting one of those account types, you have two different options or two different ways we can go about this. First, if you're a spouse, it's pretty easy. You can either continue to treat the inherited IRA as your own IRA, roll it over into your own IRA and continue on as the beneficiary, or you can roll those monies to delay required minimum distributions to the age of 73. It's actually going to be 75 by the year of 2025. I think that's 2033, actually. Excuse my error there. But you can delay those required minimum distributions if your spouse was younger than you, for example. Now, if you are not a spouse and you inherit an IRA, you must typically begin taking RMDs regardless of your age. It's going to be based off of the deceased individual's age, but there is a 10-year rule that you are going to be required to take that money out of the account within 10 years collectively as well. Some special considerations for minors here. If you are a minor and you receive money, you need to have a custodian listed or somebody who is older than the age of majority of the state that you are in, who is responsible for you until you turn 18, for example, in the state of Missouri. Then you are going to transition over to a 10-year benefit payout on that IRA as well, as most others would too. Now, there are some special rules for certain beneficiaries. There is an exception to the 10-year rule if you are considered disabled, chronically ill, or not more than 10 years younger than the account holder. Now, these are designated beneficiaries, can take distributions based off of their life expectancies though. For estate planning purposes, you're going to want to take into consideration all of these account types and the beneficiary's estate itself as well, especially if you have large IRAs and 401ks, to figure out what the best solution for you and the beneficiaries are going to be of those assets. Now, I would also suggest you talk with a tax advisor or a financial advisor on these subjects. We are happy to have one-on-one consultations, but please do not take this as financial advice until you speak with somebody on this matter about yourself directly. Thank you. So since we talked about retirement account types, let's talk about after-tax accounts or non-qualified investment accounts. Now, these are going to act a little different, so I have some examples throughout this presentation, at least on this page. So whenever you inherit assets, you are going to inherit those assets at market value. That's going to be your cost basis, meaning what does the government ask that you paid for those assets when you go to sell them in the future, whether that's immediately or 10 years down the road or whatever that may be. So for example, let's assume that I bought a stock for $50 and I passed away and it was given to my daughter, is listed as a beneficiary. And the day of my passing, that stock was worth $100 whenever my daughter received it in her possession, if you will. Her cost basis is now $100, meaning if she turned around and sold that stock that same day, she's not going to have any gains that she would owe taxes on. Whereas if she waited a little while and sold that stock at $110, for example, she would owe taxes on that $10 gain, not the entire $60 gain that I would have had if I was alive whenever I had bought and sold the positions that we're talking about in this example. So you're only going to pay on the growth after one's death, is that example I just gave you. I said $110, $120 is what I had spelled out on my example here on this presentation. You're not going to have any income taxes on the inherited value, and you should plan some sales tax around your tax situation whenever you are receiving assets in case those come into play for you. Now, again, you can sell or hold those investments. You might want to consider doing one or the other based on the market conditions, your financial goals, and any other variables that are going to be applicable to you. It's going to be very useful to sell the assets if you need the money quickly for something, or you might want to hang on to it if it is a good underlying investment and has good opportunity. Again, it's a case-by-case situation. What's going to be the best situation for you? Now, long-term versus short-term gains. This is not going to be applicable to you until after 1 year of holding those assets. So in the example where I said I bought a stock for $50, my daughter inherited it for $100, and she sold it, and I'm going to use the real numbers on the screen, $120 is what she sold it for. That $20 is going to have two different treatments of how the gains are going to be owed on it, whether it's short-term or long-term. Short-term gains are anything that you make money on in less than 1 year. Any long-term gains are going to be 1 year and a day or more. So those different tax brackets are going to be applicable to different individuals based off of their overlying income tax bracket situation. So for example, short-term capital gains, you're going to owe whatever your marginal income tax bracket is on those gains themselves. So this $20 gain that my daughter would inherit, or this $20 in gain that she received from selling an asset that she inherited for me for $100 for $120, she would owe whatever her income tax bracket is on those gains if she sold it within 1 year. If she waited for longer than 1 year, she could fall into the long-term capital tax brackets, and that's going to have for most instances, a lower overall tax bracket tied to them. The highest you're going to ever pay for long-term capital gains is 20%. It could be as low as 15% or even 0% depending on who you are and what your financial situation is. Life insurance can be a lot of fun. It generally pays out tax-free to beneficiaries. That's a big one. So for example, if I had $100,000 on my life and I listed my wife or my daughter as beneficiary on that life insurance policy, they are going to receive those assets tax-free. Big deal there. Inheriting annuities is a little bit different though. So it depends on the type of annuity and honestly the account type itself, whether it's inside of a retirement account or outside of a retirement account. For this sake, we're going to assume that it's outside of a retirement account, that any lump sum payments that you receive from an annuity and the taxes tied to them are going to vary. So the income tax on an annuity is going to be based off of what you put into it versus what's come out of it. So let's assume that I have put $20,000 into an annuity. It's turned into $50,000. It then was inherited by my daughter because I passed away. She's only going to pay taxes on the earnings of that annuity when it is cashed in. And most instances, they're going to be taken as a lump sum, or you can take those payments as a periodic payment over a certain number of years or a lifetime, for an example. Last thing on the considerations for an annuity, you want to review the annuity contracts to make sure it is going to be applicable and actually reach the financial goals that you're setting for it. And you're going to want to take into consideration not only your tax situation, but the beneficiary's tax situation as well, if you are leveraging it as a legacy goal. Real estate acts very similar to the stock example I gave a moment ago as well. So whenever you inherit real estate, your basis in that property is going to be the market value on the day that you inherited the property. So let's assume that your parents bought a property for $200,000. At their death, it was worth $300,000. Well, your cost basis in the property is going to be $300,000. So if you turned around and sold it that day and you sold it for $300,000, you have a whopping $0 gain in that instance. Whereas if your parents had sold the property 1 day before they died, they might have owned gains on that $100,000 gain that they had inside of that property. So that is something to take into consideration, especially if legacy is your goal. You might want to hang on to certain assets until death versus cashing them in prior to death for the opportunity for a step up in cost basis on either stock accounts or real estate investments. Now, I already kind of gave an example here of selling the inherited property. You're only going to pay taxes on your gains that you had from the time of inheriting the property. So in my example, you inherited the property, it was worth $300,000 that day. You then turn around 6 months later and sell it for $320,000. You would be responsible in this case for short-term capital gains because you made money within 1 year of inheriting the property on that $20,000. Whereas if you hung onto the property for a year and a half and then sold it, and only made $20,000 in that instance, you would owe long-term capital gains, which again is most of the time in a lower tax bracket than the short-term capital gains. You also could rent out the property if you decided to do so. That is going to be taxable income that you would generate from that property, so keep that in mind. You could also consider landlord responsibilities for yourself or outsourcing that to anybody else if you would prefer that to be a more passive investment, if you will. Now, some individuals do consider living in the properties that they inherit. Again, it's going to be based off of your personal needs, whether you need a property or if you don't, or if you would be better off to have the liquid cash to invest into something else for your unique situation. Tax considerations. The biggest ones that people ask me about most frequently in my office are going to be estate taxes and inheritance taxes. Estate taxes are paid by the estate before the distribution of the assets. Federal most of the time. State, it really depends state by state. I did a little research prior to this video. I believe that 17 of our 50 states do have some state level estate taxes involved in them, or inheritance taxes involved. Missouri does not, but there are some other states where they do. And now inheritance tax is going to be paid by the beneficiary. Again, estate taxes is going to be paid by the estate. So while you're alive versus while you're dead. The income tax implications, depending on the asset account type, will depend upon the taxes that you would owe on those. As we discussed earlier, IRAs, when you pull money out of those, you owe income tax on the distributions at the time when you take the money out of the accounts. Roth IRAs, in most instances, 99.9% of them, if I'm trying to throw a percentage on there, you're going to be able to pull that money out tax-free. If it's non-qualified money or after-tax stocks or real estate, you're only going to pay taxes on the gains from the moment you inherit the money, inherit the asset to selling it, because there is a step up in cost basis that happens upon the passing of the individual who owned the property or the assets prior to that. Now, there are some gift tax considerations that come into play for some. Some individuals like to give money to their kids prior to dying versus waiting to die to give the money, the estate to the kids. In 2024, you can give up to $18,000 per person, whether it's your own kids or the random stranger walking down the street. You can give $18,000 to as many people as you would like before you would start affecting your estate tax and inheritance tax liability limits. As of 2024, those limits are going to be $13.61 million per individual. So for example, if I gave a child $100,000, then the first $18,000 I can give to them without any repercussions per se. But that next $82,000, that is going to come off of my total collective $13.61 million that I can give away prior to estate taxes coming into play. I've done another deep dive video on this. I'll have to link it at the end of this video on that particular subject, but if you would like, I can make a refresher course if that's something that's requested down below in the comments. Now again, state-specific tax laws, it's going to depend state by state. For example, though, Pennsylvania does have an inheritance tax, while California and Missouri do not. Some strategies to consider when you do inherit money. First, I would look at your immediate versus long-term goals and decisions that you need to make. Do you need to pay off any immediate debts or credit cards or anything of the nature, or do you need to do more saving towards retirement? I would also consider looking at your own personal estate plan, documenting or looking at your documents, whether those are wills or trust or powers of attorney, anything of that nature. If you inherit money, that's always a very good trigger point to start looking at that situation for yourself. I do always suggest speaking with a professional about those matters, whether it's just for some general information or if you want to work with somebody one-on-one to make sure you're doing exactly what is necessary for you and your financial goals that you have for yourself. The last piece that I bring into play is considering investing it. You can diversify your investments to spread your risk out, but to not put all your eggs into one particular basket. And when you have legacy money, you want to consider the tax implications of those as well. So do some tax planning at the same time. Thank you for joining me in today's journey. I know estate planning and if you inherit money can be something that is a daunting task to try to get figured out. I promise you it's really not that bad, especially if you get your ducks in a row for your beneficiaries and your situation. So we discussed quite a bit today. If you derive value from this video, please consider sharing and liking the video. It does promote my video to get in front of more people on YouTube and other channels so I can provide more valuable information to them. It really does help. So thank you. Lastly, remember you're not alone in this journey. We're here to guide you through every step. So if you would like any one-on-one consultation with us, our contact information will be in the description below. Otherwise, thank you for your time and have a great day.